Constant rain washing out roads and subways and stocks on Wall Street. Stocks sliding to wrap up the month of September and the third quarter. The S&P 500 and Nasdaq are on track for their biggest monthly decline of the year. This coming despite a better than expected reading on inflation for August. We break down the big movers and what to look for when the fourth quarter kicks off next week.
Plus, the United Auto Workers expanding the strike to more Ford and General Motors plants. Stellantis spared this time around as UAW President Shawn Fain says there's been some progress on talks with the Chrysler parent. But Ford and General Motors not taking the action lightly. The company's firing back with Ford CEO Jim Farley saying in a statement that it is, quote, grossly irresponsible to expand the work stoppages.
And the government likely heading for a shutdown tomorrow night. A group of conservative House Republicans joining Democrats to vote down a GOP bill to fund the government. And it marks a significant setback for House Speaker Kevin McCarthy. And as now there is no clear path to prevent a lapse in funding.
Let's get you up to speed on the market action today. We have had stocks sort of bouncing around over the course of the session. Earlier, things were looking a little sunnier. Now, only the Nasdaq's in the green, up 0.4%. The S&P and the Dow a little bit lower, but the Dow only off by about 1/3 or down about 100 points for those who had been hoping for a reprieve on the last day of the quarter. Well, they're not really getting it. And checking in on yields as well, which we've been watching closely as of late. We have been seeing a little bit of relief on that front, but really very small relief. Seeing a 3 basis point decline in the 10-year, for example, to 4.57%.
And the market on pace here for losses for the month and for the third quarter. Meanwhile, the S&P 500 and Nasdaq on track for their worst month this year. So wrapping things up, Julie, no shortage of headlines. I've got oil, UAW. We got government shutdown. We got rate pressure. Seasonals were also interesting. I often, when it comes to seasonals in September, I kind of don't know whether to overplay that. It always feels like kind of a squishy topic. Yes. And I always feel like, well, if we're talking about it, it's already priced in. But September, again, proved kind of rough for the bulls.
Yeah, the worst month of the year thus far for the S&P 500 at least, and for the Nasdaq as well. There was just sort of this confluence of factors getting close to the end of the rate hike cycle. We don't seem to know what that is going to mean. And if you take a look at the Wi-Fi Interactive, you can see the downward trajectory we have seen here in the month of September. Here you got the Dow over the past 3 months here. But if you look at the month and what we have seen, you see that big tumble there in the Dow, the tumble in the S&P 500, nearly 5%, and the Nasdaq also trading lower here. So all of these seeing some pain. You were just talking about what we've seen in some other asset classes as well. And obviously this month has really been characterized by this increase in yields on the 10-year. That's been one of the things that has been problematic for stocks. And then, of course, one of the other things that's been problematic for stocks has been the surge that we've been seeing in oil prices. If I can scroll on down to oil futures, there they are, and that big increase above $90 a barrel that we've been seeing.
Yeah, I mean, rate pressure is front and center, though. I mean, now with yields, you're really in spitting distance of 5%, and some think, listen, maybe you go higher on Fed messaging and issuance. And you can forgive some investors probably think, you know what, I want to see some stability there before I move in.
Yeah, that seems to be somewhat of the perception here that we are seeing. But there also is the perception that we don't know, to your point, where yields are going to stabilize. Are we going to see some support under the bond market, though, with yields at these levels? That seems to be the perception as well. But I don't know what that means for a ceiling for yields, right? You have the likes of Larry Fink over at BlackRock saying we could see 5%. You had JP Morgan's Jamie Dimon earlier this week floating 7% for the Fed funds rate, which doesn't seem like it's happening anytime in the very near future. So to your point, though, there's a lot of sort of unsteadiness here.
Yeah, and you also think about, Julie, how many people right now are thinking, you know what, I can just sit tight here. I'm okay. I mean, for the first time in a long time, there are alternatives. They're looking at T-bills or money market funds. They're yielding 5%. There's a lot of people who are thinking, I don't have a lot of motivation to make a big move right now. I can sit still for a bit.
Yeah, that seems to be what some folks are thinking. Well, let's get another perspective on what's going on in the markets at these levels here, and also with the economic data that we've gotten. Mixed as the month draws to a close in today's session. September's been the worst month for the year, as we've been talking about, as the Fed has message that rates might stay higher for longer. And all of this coming as the latest PCE figures are out, the Fed's preferred measure of inflation, as it's known, coming in lower than expected, a reassuring sign amid fears of further rate hikes. Overall, the PCE rose about 0.4% month over month. That translates to 3.5% year over year. And the core PCE, excluding food and energy, up just 0.1% on a monthly basis, that is, and 3.9% year over year. Initially, that was greeted with some enthusiasm by the markets, but then that sort of faded away. Joining us now, Callie Cox, U.S. investment analyst at eToro, and Jose Torres, who is Interactive Brokers senior economist. Jose, I actually want to start with you here on looking back to this morning's PCE figures, which do seem to show a positive movement here, going in the right direction. Then you had John Williams of the New York Fed out and saying we're at or near the end of Federal Reserve rate increases. How should investors be reading all that?
Absolutely, Julie. And another thing, we also had Euro inflation data that came out this morning that was better than anticipated. And those two reports in tandem, actually, we started off pretty bullish in the morning until the shutdown fears reversed those gains. A lot depends on the headwinds that may occur if we do get the government shutdown, which appears very likely. Also, the auto strike also provides some headwinds to economic growth and to employment. So to the extent that those two events dampen economic momentum, then yes, then we probably are at peak rates for the Fed and for the ECB.
And Kyle, let me get your take on the issue as well. You know, Julie and I were just discussing the kind of rate pressure we're seeing, right? The yield on the benchmark 10-year, it's around 4.6%, spinning distance of 5%. What kind of challenge and headwind does that pose to the equity market?
Yeah, well, I mean, you just said it. Yields are at a 16-year high right now, and that raises borrowing costs. That, you know, makes investors think about the alternatives they have instead of putting money in riskier assets. You know, maybe put a little bit of that money in cash, and all of that plus, you know, the different weights we have from oil, from the strikes, as Jose said, you know, from the potential government shutdown that looks like a near certainty right now. All of that leads to cooler confidence, cooler spending. And I actually think it's hard to take yields at face value now because of all of these storms converging on markets and investors at the moment.
So what does that mean then? If you're not taking, you said don't take yields at face value. Like, what does that mean? Translate for us. And what does that mean for investors?
Yeah, so I think the big question in the market right now is, you know, the 10-year yield is at 4.5%. And that should mean good things about the economy, right? Because yields rise when the economic outlook is getting better. Of course, you know, right now there are fears about inflation picking back up, which I think core PCE disproved right now. But when I say, you know, don't take yields at face value, I'm saying, you know, the fair value of them should be lower here. So this move that we're seeing higher could be technical, could be supply driven at the moment. I'm not sure how long it'll last, but look a year down the road, 10-year yields probably won't be at these levels.
And Jose, as the economist on the panel, I have to ask you about the government shutdown. It does look like we're careening into one. What kind of risk does that pose for the economy, Jose?
Well, unfortunately, it poses grave risks. You know, employees don't get paid, the airports start functioning at slower speeds, and it really dampens confidence. Particularly, Moody's is probably going to downgrade the U.S. debt next week if the shutdown occurs. And to the points earlier on yields, you know, that'll probably lead to a pickup in yields. You know, yields are suffering right now from a wide variety of headwinds. You know, one is sticky inflation, the other is the Fed winding down its balance sheet. International buyers like Japan and China aren't showing up to the table as much, you know, and it's really left to individuals and hedge funds for the most part to pick up a lot of these treasuries. And of course, there's the appetite to issue debt right now is also at pretty close to record highs. So I think actually yields can go a little higher from here.
Callie, it doesn't, for all that the market has struggled this month, it doesn't feel like necessarily the shutdown has been a big part of the reason why, or has it? And will it, if indeed things shut down? I mean, it looks like at this point it's going to happen.
Yeah, it certainly does. And I think it's a distraction for the market right now. If there are investors looking at those headlines and pulling money out of equities because they're getting worried, I'd probably say to them that there are bigger risks to be worried about. I think the main risks for the market right now are rising oil prices, which hit the consumer a lot harder than other headwinds we're facing at the moment, and rising yields, which again can be a problem for any American taking out debt, any company taking out debt right now. So there are a lot of unusual headlines popping up, and they do have their own risks. But right now, I'd say that oil and yields are the two main risks to watch for.
And Callie, as we exit September here, what are the catalysts on the horizon for you? I mean, we have earnings season right around the corner, a few weeks. We'll start hearing from those big banks and something. Listen, maybe that's the catalyst that puts the bulls back in charge. What are you expecting from this earnings season?
Well, there's certainly not a lack of things to be watching, right? I think earnings season, you're right, is going to be a nice almost influx of data for investors to kind of latch onto. And, we may be out of the earnings recession. Wall Street analysts are expecting earnings to grow just a slight bit year over year. So companies may have that good news that we're just lacking at the moment. I think that could be a good foundation for the market to build on. Of course, the other way can happen too, like maybe we're going into this earnings season way too optimistic, but I think the former situation is probably more likely. We've just underestimated corporate America for way too long.
Well, and maybe earnings season is going to be even more important because we're not going to get other data, or at least not other data from the government, right, Jose? Because if the shutdown happens, we're not going to get the jobs report, we're not going to get inflation data, et cetera. What are you going to be watching most closely here, if that is indeed the case, to give you an idea of where the Fed might go next? And what do you think the Fed's going to be watching?
Absolutely, Julie. We're going to be flying blind to the extent that the shutdown is extended. Thankfully, the Federal Reserve will be, and its regional branches will be releasing data, because that's not an agency that's appropriated by Congress. So we'll have some data. We'll also, due to the pandemic, the high frequency data series were born and have been flourishing. So we'll have a lot of high frequency data. So we'll be watching Red Book retail sales. We'll be watching commodity prices. We'll be watching mortgage applications. A lot of the private sector data providers will be watching that during this period. Also, given that we have an election year next year, there are risks that this shutdown could be particularly lengthy, as both sides fight for leverage ahead of the election.
We shall see. Guys, thanks so much. Have a great weekend. Callie Cox and Jose Torres, thank you. Let's check in now on a few trending tickers that we are watching. We start with Walgreens Boots Alliance. The shares higher today following a Bloomberg report that the company is considering a former Cigna Group executive, Tim Wentworth, to be the next CEO. Walgreens has been searching for a new chief after it announced the abrupt departure of Rosalind Brewer from the position earlier this month. And Roz Brewer had really tried to beef up Walgreens' sort of broader healthcare bona fides to compete against CVS. CVS has been sort of the clear leader in that area. Wentworth, obviously coming from an insurer, and he had been at Express Scripts as well, might be the one to help Walgreens further in that direction.
Yeah, and in Rosenberg, so when she departed, of course, that was an abrupt departure.
Yes.
It took a lot of people by surprise. She did try to move them into, as you said, kind of a bigger player in the healthcare space, acquire the urgent care providers. But that stock, Julie, of course, has been a mess. I mean, it's down about 40% so far this year, but maybe investors taking some page of optimism here. Maybe they get a tested veteran in there into the C-suite, changes some things.
Yeah, that seems to be what it is. A little relief there being felt in the shares.
For sure. All right, shares of Trimble and AGCO in focus. That's following news that AGCO will acquire an 85% stake in Trimble's agricultural products business. Companies say the joint venture is meant to better serve farmers worldwide with mixed fleet precision agriculture solutions. Trimble also hired today on the back of an upgrade from Raymond James to outperform from market reform. We have the AGCO CEO coming on later. Excited about that interview. Lots of questions for him. What does it mean for competition in the marketplace? I think is a huge one. What's it really mean for farmers? And also his stock, Julie, has not been a performer. It's down about 10% for this year. So also just interested to get his take on what gets investors excited again about owning that name.
Right. The buzzword here is precision agriculture, right? Is how can farmers be more efficient with what they are doing? Precision agriculture has a lot to do with using technology in order to get the best yield from farms. And I've spoken to Eric Cansocio, the CEO of AGCO, before, and that's one of the things he's already emphasized. And now this Trimble acquisition of these assets is aimed at further improving that. It's interesting that Trimble itself is rising for a second day after this acquisition. And Raymond James pointing to what they say is their long-term favorable thesis on the stock and the evolution to a, quote, more software recurring revenue-centric mix. They also talk about less cyclicality for Trimble, which is interesting because that's also one of the things that AGCO talked about as being a benefit of this deal. So that's something else that we can ask the CEO about.
Can't wait for that interview.
Yeah,
that's a good one.
Should be good. And then another, speaking of another interview that we're looking ahead to, and another mover that we're watching, Carnival shares in the red today after the company reported third quarter earnings, the cruise line topping expectations, but fourth quarter guidance looking like a concern for investors. The company said it does expect a wider than expected loss of between 10 and 18 cents a share in the final quarter of the year. Part of that having to do with fuel costs going higher. We've been hearing that a lot from the airlines as well. Obviously, when oil goes up, translates into all kinds of higher costs for companies that depend on the fuel.
Yeah, and remember this one too has been a rocket ship. So a lot of good news was priced in there. But yeah, I mean, it was the guidance here. Adjusted EBITDA guidance, 800 to 900, and the street was closer to 950. Challenges like those higher fuel costs for sure weighing on them.
Exactly. And I mentioned the CEO, that's Josh Weinstein, who's the president and CEO of the company. He's going to join the program later in the hour to discuss those earnings with our Brian Sazi. We're just getting started here on Yahoo Finance Live. Coming up, what's next for the United Auto Workers? We're going to break down the latest comments and the next steps of action in the strike. Plus, it's the last trading day of the month and the quarter, and we're recapping the last few months and diving into what to expect in Q4. All that and more when Yahoo Finance returns.
Sphere at the Venetian Las Vegas took almost 4 years and an estimated $2.3 billion to build. Standing over 360 feet tall and 516 feet wide, Sphere is the world's largest spherical structure. It includes a world record 580,000 square foot, fully programmable LED exterior. Inside, Sphere has another 160,000 square foot wraparound LED display canvas. It has a capacity of 20,000 standing spectators, or 17,500 seated guests, including 23 VIP suites. Sphere's immersive sound is the world's largest beamforming audio system, utilizing more than 160,000 speakers. At Sphere's Grand Atrium, visitors will encounter 5 AI humanoid robots who will introduce them to Sphere.
I can't wait to meet you. See you at Sphere.
Sphere will host a wide variety of unique entertainment events, beginning September 29th with the first of 25 performances by U2, followed in October by the Sphere Experience, featuring director Darren Aronofsky's Postcard from Earth. Let's do a quick check of the market sponsored by Tasty Trade. Right now, mixed session. The Dow, you can see there, down nearly, you can call it 0.5% right there, about 152 points. Was higher in the day, but now edging lower. Of course, news of an impending potential government shutdown, perhaps adding to some jitters as we head into the weekend. The S&P 500 down about 0.2% to 42.92, and your tech-heavy Nasdaq is down. Is up about 0.3%. And a quick check on the VIX as well here, referred to, of course, as the fear gauge. Hit 20 earlier in the week and now sitting at about 17, Julie.
Well, the United Auto Workers expanding the strike to Ford and GM plants, while UAW President Shawn Fain points to progress made with Stellantis. Meanwhile, Ford is warning that given the fragile supply base, there's not much time to reach an agreement and avert disaster, in its words. As the strikes carry on, we're also taking a look under the hood at what analysts are expecting in the run-up to the latest auto deliveries data for Tesla specifically. Joining us now to discuss is Autoblog editor-in-chief Greg McLeory. Greg, it's great to see you as always. We know you're on strike watch, as we have been here. And besides Stellantis, doesn't feel like we're any closer to a resolution of all of this. What do we know about when and how acutely it's really going to start to affect production? I mean, I guess it's affecting it at the plants already, but sort of in a more critical mass fashion.
Hey, Julie, good to see you guys. I think it's going to take a few weeks for, the strike to really have an impact on production and perhaps prices and sales. As you look at new car sales predictions for September and for the third quarter, it looks like they're going to be pretty solid. Primarily because the strike has been targeted. So it's only been a few factories so far and, a few certain vehicles. And it also didn't start until September 15th. So there really hasn't been a lot of time for the impact to have been felt right on, the bottom lines for, the metrics we're going to look at.
And Greg, as we look at the negotiations between the UAW and the Big Three, we often focus on wages, and for good reason, and they're far apart on that issue, it seems like still. But there are other issues as well, right? And when we think about pensions and wage tiers, a lot of moving pieces here. And one reason I think some people think this could actually drag on for a while. What's your take?
I think it could be a while. Every day, every week that goes by that we don't see a deal, it looks like there's going to be an expansion of the targeted strike. We saw that again this week with 2 more factories. There's one near Lansing, which makes the Buick Enclave and the Chevy Traverse, and then another Ford factory that makes the Explorer and the Lincoln Aviator. Those are definitely significant factories to go offline for these 2 automakers. I was a little bit surprised, frankly, to see that there was a fair amount of progress on the Stellantis front, and Stellantis was not included in this latest round of the strike expansion. So I think the more the time passes, the harder it could be to get a deal. I mean, ultimately, they're going to have to work this out. So it will end at some point, but it seems like they're pretty far apart right now. I mean, specifically, I think the wage issue is something they're going to be able to iron that out. At some point, you kind of come together, you look at the numbers, and you make a deal. But there are probably more significant issues like pensions, like the tier system, like the access for the UAW to unionize some of the battery factories. Those are all critical sticking points, and it doesn't seem like they're making a lot of progress there.
Well, there's the substance of the negotiations, and then there's the rhetoric surrounding the negotiations. And on that point, it feels like the claws are now coming out at this stage. I'm just looking at some reports from an automotive news reporter that says, that quotes Sean Fain as saying Jim Farley is lying about the state of negotiations, and kind of get some other barbs in there. In your time, looking at this strike and other strikes, how much does that factor in? In other words, like if they're very publicly being sort of nasty to one another, what does that signal about the negotiations?
I mean, sometimes it means nothing. Sometimes it's all basically, made for TV, and then what's going on behind the scenes can be very productive. I think perhaps in the past we've seen some of that. The most recent strike that lasted for over a month in 2019 that impacted General Motors. There was definitely some rhetoric, some animosity that went around, but by and large, they did eventually get a deal done in fairly reasonable order. This time around, I think Sean Fain, the UAW president, has done a very good job of sort of controlling the narrative. He's been very active on social media, on Facebook and YouTube, and those are all like modern media tactics that we haven't really seen from the union in recent years. So he's been very, using that in a savvy manner. Today, I think you saw Jim Farley, who had a press conference at 1 o'clock Eastern time. I think he kind of hit back. He is an executive who's known for basically saying what he thinks. And I think his sort of frustration showed through today. He definitely tried to make his case and, take it directly to the media, to the people, on their own live stream today. So it definitely seems like not only are the sides farther apart, in the case of Ford, it does seem like things are, definitely heating up in perhaps a negative way.
And Greg, that's so interesting to me, because I was under the impression that Ford had a better, or at least relatively better, relationship with the UAW than the other two. Does that not seem to be the case anymore? I mean, it does, to your point, seem like that relationship even is getting a lot more heated.
So as recently as last Friday, Ford was actually not included in the latest round of strike expansion. It did seem like they were making more progress. Ford struck a deal with Unifor, that's the Canadian union, last weekend. And it just seemed like, hey, maybe Ford is going to be the first one in the United States to actually make some significant progress on a deal and actually get something done. So frankly, I was a little bit surprised to see that they were included in this latest round of the expansion of the targeted strike. I know it's a significant factory, too. It's the Aviator and the Ford Explorer. Those are bread and butter SUVs for Ford. So historically, Ford has actually had a pretty good relationship with the union over the last, 30, 40, 50 years. Ford is very proud of its heritage as like a family company. They didn't even go public as a company until the 1950s. So it's definitely something that I feel like their leadership tries to take to heart. Jim Farley, the CEO of Ford, he'll tell you the story of his relatives who actually worked in Ford factories. So I agree with you. It was a little surprising to see Ford definitely included in the latest, expanded part of the strike, and then kind of hit back today.
Pivoting to a company that has no relationship with the unions, I'm talking about Tesla, because we're also looking ahead to the company releasing its monthly delivery data, probably Sunday, Monday, we don't know exactly, but probably in that time frame. And there have been a lot of analysts cutting their estimates for those deliveries in the past week or so. What are you hearing, and kind of how are they fitting into the delivery estimates while all this strike stuff is going on?
So Tesla, basically, it looks like you may see deliveries down when they announce the next, round of, figures for the third quarter and for the rest of the year. A good part of that is they've done some updating to their model line. So that means they have to make some tweaks in their factories. So in some ways, that's almost like what a more typical mainstream automaker would do, is you slow down production as you transition to the new model year. So I think some of this is actually to be pretty expected. But Tesla being Tesla, it's always big news. It's always They're definitely under the microscope as to, how their sales figures are, their prices, because Tesla's been very willing to cut and raise prices in a dynamic fashion that we don't see some of the other traditional automakers do. So it looks like, looking into the crystal ball, it may be a little bit of a softer quarter for them, but I think that also may be partially by design.
And Greg, final question here. I just want to stick it on Tesla. There are some financial analysts, Greg, who follow this sector, and they say that Elon Musk probably has champagne on ice. Their words, right? Because their point is the big three, their labor expenses are going up. We don't know how much, 20%, 30%, but they're going up. And Elon Musk, they'll argue, and Tesla are the winner. Do you buy that, or is that too simplistic?
I think that's too simplistic, because when you look at, the economies of scale that's going to go on here, the Detroit Three have, far more factories than Tesla does. So labor is just part of the many costs that go into making an automobile. I think this is a situation where certainly if costs go up for the Detroit companies, that could benefit Tesla. It could also benefit, other car makers, but we don't really know that right now. And, Tesla has its own challenges, its own costs that are built in, and it has a much smaller footprint. So, and there's always the chance that the UAW could try to unionize some of Tesla's factories. It might seem a little far-fetched, but you never know. So I think it's a little too early to see the direct impact on Tesla.
I would love to see Elon Musk's reaction if that was attempted. Oh, I would love it. We'll see. Greg Migliori, always great to catch up with you. Really appreciate your time on this Friday, and have a great weekend.
You as well.
Thanks. Well, it's not just the UAW. It felt like at least, the summer of strikes now spilling into the fall. More unions, in fact, are now threatening to head to the picket lines. Currently, we've got casino staff in Vegas, video game actors, and workers at one of the largest healthcare providers in the country are now threatening walkouts. We're talking lastly about workers at Kaiser Permanente. They say they're going to hold a 3-day strike as early as next Wednesday if negotiations today do not reach a deal. If they strike, that could hit hospitals, clinics, and medical offices. And this is a consistent theme that we've been talking about that is so fascinating, with union membership falling back, but these kinds of actions, these really visible actions that are hitting large swaths of people that have been ramping up. The Kaiser one is interesting in particular, could affect 75,000 employees across 5 states and Washington, D.C. if it happens. And then, of course, by extension, a lot of patients.
Yeah, I mean, listen, as we were discussing, so many strikes now across so many sectors and industries, it's hard to keep up with the headlines at this point. I think big labor knows this is a moment they can act. They're looking at the labor market. They see a sub 4% unemployment rate, and they think, you know what, we can make a move here. And not only are they making moves, they're going to the negotiating table and securing better pay. And to the extent that then motivates other companies and other industries. I thought what Greg just said was really interesting about the UAW. I mean, let's say Sean Fain's really able to secure, let's call it 30% pay raise over 4 years. Not only would I think that would make his members happy, what extent does that motivate others, including even, as Greg said, maybe he says it sounds far-fetched, do non-union members in all other companies like a Tesla look at that and say, you know what, maybe that is looking pretty good. And maybe the UAW makes a play for them as well. They would obviously love to bump up their membership.
Well, if you look at other industries entirely disconnected as well, I mean, the writers, for example, in Hollywood, it looks like that they got a fairly beneficial deal for themselves and got many of their demands met. So if you're a leader of a union, whatever union it may be across this country, and you're seeing these actions, it's going to be very interesting to watch union membership in the coming years. Which is still historically low, around 10%. Correct, exactly. But to your point, if I'm a worker in whatever industry it is, and I'm seeing this kind of stuff happen, it's quite interesting. I mean, another example of a worker action that was not among union workers happened at CVS stores in Kansas City, where they staged a walkout recently and then repeated it this week. Basically, that didn't have to do with pay. It had to do with personnel and staffing, which is part of the issue at Kaiser Permanente as well. We have seen big problems with getting healthcare staffing up in this country, and that has created big problems for those who are working, right? That if they're stretched thin in seeing patients, or if you're a pharmacy and you're stretched thin in writing prescriptions and advising patients, and there aren't enough people working there. And so CVS came back, and its chief medical officer made comments to the chief pharmacy officer, addressed these concerns and said that they are going to be beefing up staff. So these worker actions are getting results in many of these cases.
Now, the other side, though, Julie, think about is your take on right-to-work states, right? To the extent that there are conversations happening, I'm sure, in boardrooms across this country right now, thinking they're looking to keep building operations. They're looking not quarters, but years down the line. Does that kind of motivate, okay, we're seeing the headlines, we're reading the same articles as you are. Does that motivate them and their decisions about where exactly they want to build that next facility?
Yeah, I mean, some companies have more flexibility on that front than others, right? If you're CVS, I mean, again, those weren't unionized workers, but you're everywhere. If you're a Kaiser Permanente, you have a very broad geographic footprint. So obviously there's different flexibility depending on what you do.
It's a big, powerful trend, so we're going to keep watching it.
We are.
Coming up, the cruise industry sailing to new highs as Carnival reports all-time record revenue in the third quarter, but it might not be smooth sailing from here. Carnival CEO and President Josh Weinstein sits down with our very own Brian Sozzi. On the other side, stick around.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Carnival Corp out with better than expected results. Let's get right into this quarter here with Carnival CEO Josh Weinstein. Josh, good to see you again. Thanks for making time for Yahoo Finance. And to me, I have to be upfront with you. This is a head-scratching market reaction. Why do you think the stock is selling off in what appeared to be a pretty darn good quarter and pretty darn good outlook?
Well, you know, our job is to deliver what we say and ideally out-deliver, and that's exactly what we did in our third quarter. We out-delivered on revenue, on the booking trends, on the onboard spend. So really, I couldn't be prouder of the team for what they've accomplished, and we carried that forward, and we upped our guidance for the full year, and we said we expect our per diem trends to continue as we continue to just close that occupancy gap back pretty much entirely to historical levels. As a result, we took up our yield guidance for the fourth quarter, and the momentum is great. So, you know, all I can tell you is we'll keep trying to just deliver on or out deliver, and hopefully the stock will match up with that.
Is there something near term that's giving you pause?
Well, from my perspective, as far as how we're running the business, really not much. You know, on the demand side, all we see are green arrows going up. You know, we've got record booking levels. We're 10 points better booked today than we were a year ago, looking out for the next fiscal year. On top of that, we're booked at higher prices. And so we've got some stickiness as we look out over the next 12 months. The onboard spend levels haven't slowed down. So the absolute amount that our folks are paying when they're on board for experiences, be that F&B, shore excursions, casino, communications, you name it, that hasn't slowed down. And one of the most encouraging things is, you know, a year ago, we were talking about a bit of a dichotomy between the pace of the recovery for North America versus Europe. Well, I'm really proud to say that our European brands, AIDA, Costa, they outperformed too. And they just came off of a third quarter where their yields were higher than 2019. And they're driving a lot of that booking outperformance as we look forward. So as far as I'm concerned, from that perspective, everything that we're trying to achieve, we are hitting the mark and then some. Well, remains to be seen.
Josh, I thoroughly read your earnings release. I led to, of course, listen to the earnings call. And your report, booking strong, occupancy strong at higher prices. You're calling out good things for the next 12 months in terms of forward bookings. Square that up with what we're seeing from the U.S. consumer. We're seeing credit card delinquencies rise. We're seeing auto sales slow, but yet consumers are getting onto a cruise ship. How do you explain that?
Well, I think you got to start on the premise that cruising is inherently an unprecedented value compared to land-based alternatives. We quantify it anywhere from 25 to 50%. So ideally, we want to outperform in any environment. And in an environment where maybe the macroeconomic trends are getting a little worse, candidly, we've heard about a recession for the last 18 months, and I'm sure it will come. But let's say it is coming. You've got an experience that cruising can provide, and the relative value, making your vacation dollar go further, plays very well into cruising. And so maybe there's just a combination of the fact that we offer a great product, and people are really starting to see the value. We're really trying to push on that messaging so people who have never cruised before can really understand that and come sail with us. And I think that's working. As a matter of fact, if you look at our trajectory of our guests carried, our loyal guest base is pretty much been consistent in absolute numbers when you look back from the fourth quarter of last year all the way through the third quarter. A huge amount of growth, and it's all been really pushed forward by first-time cruisers and new to brand. So the message is getting out.
Do you get worried that if we do get this government shutdown, your business in large part is all about confidence? I have confidence that I'm going to have a job a year from now. I'm going to put a deposit down on a cruise vacation. There is confidence in the financial markets. You're a company that is cutting debt, but still has a lot of debt on the books. What would a government shutdown mean to a business like yours?
That's a great question, and I wish I had an answer for you. We've been through government shutdowns before, and we've been through recessions before. And the good thing is we are a resilient business because of that value play, because of the advanced nature of our bookings, where we have a pretty good amount of visibility as opposed to lots of other industries. And again, holidays, vacations, they're sacred to a lot of people. And so they will move heaven and earth to figure out how to make ends meet in order to protect the sanctity of the vacation. And we appreciate that tremendously. We understand how big of a responsibility that gives us to make sure we deliver. And the NPS scores are great. The satisfaction scores are great. So we think we're really clicking on all cylinders.
I need to give you some props, Josh. I talked to you at Milken, and you really made it a key point to point out, Brian, we're cutting debt, and we're going to cut it aggressively, and you have. Where do you want to be in terms of debt for Carnival looking out over the next year?
Well, I'll tell you, we've come off of our peak of a bit over about 35.5 billion. We're already down over 10%, and I'm real proud of that trajectory. I'd say as we look over the next 3 years, we've set out targets that get us through 2026. And what we've said is very clearly, we expect to hit investment grade credit metrics by the time we're done with 2026. And so that would imply that we've got another 10 billion to go, and we expect to be able to accomplish that over the course of the next 3 years. I would say next year is, relatively speaking, when we have the most growth in capacity. We've got 3 ships coming next year. So that'll be a year that won't necessarily be as big of a driver of debt reduction. But after that, with 1 ship in 2025 and 0 ships coming in 2026, that gives us a tremendous amount of headroom to kick off billions of free cash flow to directly go to pay down debt, because getting our balance sheet back to a much better place is very much a primary focus.
Good to see that narrative continuing. All right, so your bookings are good. You seem like you're ready to withstand if a government shutdown of any kind. Now, what about oil prices? We have seen oil prices tick up to about $100 a barrel. How much of a headwind is higher fuel to your business right now?
Yeah, no doubt. No doubt that hurts. And it covers up actually a lot of the good things that we talked about, I think, on our earnings call today. We outperformed in the third quarter, for example, and we actually raised our guidance, our EPS guidance for the full year It's about $200 million worth of good things that we're doing on the revenue side, on the fuel consumption side, which I'll come back to. But unfortunately, the change in fuel prices and the dramatic nature of this spike has basically taken $125 million or so away from us. Now, the one thing that we are maniacal about is you can't really control the price of fuel, right? But what you can control is how much you use. And no matter what the environment is, no matter what type of fuel we put into our ships, if we use less, we save money. And so we actually are going to be outperforming what was a pretty audacious goal of a 15% fuel usage reduction versus 2019 and carbon intensity. We're going to hit 16% this year. So 16% reduction in unit consumption, that translates to a $375 million savings in 2023 as a result of that activity. So we're going to continue to focus on the one thing we can control, which is using less.
Good to see that turnaround continuing at Carnival. Carnival CEO Josh Weinstein, good to see you again. We'll talk to you soon.
Sounds good. Thanks very much.
All right, much more ahead on Yahoo Finance. Do stick around.
There's always hope, and I don't believe in a no-win scenario. Like, we understand what a shutdown means to the government, to the American people. I certainly do not want that, and so we also have some other Republicans on the more moderate side that certainly don't want that. It's an interesting situation. I hope that during this weekend we can come to some solution and come back and work it through.
The odds of a shutdown are increasing. Modern, mature governments should not be shutting down. It's certainly a crazy impact, probably an impact on the markets, an impact on the economy, an impact on all of the government operations essential to keep society humming along. And right now, the House is talking about going out for 5 days and coming back next Tuesday. And at that point, they would just have till midnight Saturday to work out a continuing resolution. So things are looking worse than they did a couple days ago.
The real problem right now is Speaker McCarthy continues to be really led around by a very far-right extreme contingent in his caucus. Look, at the end of the day, if Speaker McCarthy agrees to put up for a vote in the House the kind of bipartisan proposals that we're sending from the Senate, I'm confident that they would pass. The question is whether he will put the country before his own interests and move forward in that way.
Major bank CEOs heading to Capitol Hill to face a grilling before the Senate Banking Committee. Jennifer Schonberger here with the details. Jennifer.
That's right. The Senate Banking Committee announcing this morning that they will haul the CEOs of the nation's largest banks before that committee on December 6th here in Washington. Amongst those that will be on the hot seat later this year include JP Morgan's Jamie Dimon, Bank of America's Brian Moynihan, Citigroup's Jan Fraser, Goldman Sachs' David Solomon, and Morgan Stanley's James Gorman. Now, analysts expect the executives to really use this hearing to criticize the new Basel III capital requirements proposed by the Federal Reserve earlier this summer that would require banks to raise capital by some 16% in aggregate. Bank executives expected to argue that it will hurt credit availability and really push operations into the unregulated shadow banking system. Now, this is the third year in a row that Senate Banking Committee Chair Sherrod Brown has hauled these CEOs before Congress here in D.C. Brown saying in a statement, quote, "It's our job to hold them accountable to their workers, to their customers, and to the American people. Wall Street mega banks continue to make record profits and to reward corporations that raise prices on Americans." Josh, again, this hearing happening December 6th here in Washington. Back to you guys.
Jen, Julie here. You are also watching. You mentioned Jane Fraser, the Citi CEO, a moment ago, but she's also making some other comments about the economy, the state of the bank also. What stood out to you?
Hey there, Julie. Happy Friday. Good to see you. Yeah, that's right. Citigroup CEO Jan Fraser making some comments this morning in an interview on CNBC, saying that she expects the Federal Reserve to raise interest rates at its November meeting, but hopes they won't have to. She also thinks the economy can avoid a recession and achieve that so-called soft landing. And she also made some comments on Citigroup's previously announced news for layoffs, saying that Citigroup is really hoping to flatten out the organization, remove some of those complexities, and that she expects to announce sometime in the fourth quarter an actual headcount reduction, as well as the cost savings that are expected from those actions. Julie?
Yeah, interesting story there with Citi. Thanks so much, Jen. Appreciate it. Have a great weekend.
Thanks, you too.
A tie-up in the agricultural sector, AGCO investing $2 billion in assets from Trimble. That'll end up in a joint venture. The goal to boost its offerings in the precision agricultural business and better compete with industry leader Deere. Joining us now, AGCO CEO Eric Hansotia. Eric, it's great to see you again. Really interesting deal that you guys announced yesterday. Precision agriculture, for folks who are not familiar with it, what does that entail? What does it include? And what is this going to do for AGCO?
Yeah, precision agriculture is all about helping a farmer get more yield out of their farm with less inputs. Putting sensors on machines to be able to understand variations in the soil or variations in the crop, and then having the machine do onboard compute, sometimes using artificial intelligence libraries, and having real-time adjustments to have the machine optimize itself. Farmers get a lot of value out of this. They can raise their yields. They can treat each spot on the field differently, optimizing their inputs like fertilizer and fuel and seeds and things like that. And it's kind of the big area that we're focused on.
It seems like it's the big thing sort of in agriculture generally right now as well for farmers. I'm curious, I know that you guys bought this new technology and are putting it in this joint venture with Trimble. When you're trying to market this to farmers, I imagine there's an added cost for them. What has been the demand from farmers for these kinds of products, and how much of this is adding on to what AGCO already produces, and how much of it is that you plan to produce new development and new products from this partnership?
Well, this deal, it's the biggest ag tech deal in history. So it's large in size, but it's also very interesting in that, to your question, it allows us to not only grow our capacity and scale to innovate on our machines, on our AGCO tractors, combines, sprayers, planters, but Trimble and AGCO are kind of the only two main companies that have a mindset of, we call it mixed fleet. That means we'll sell technology on anybody's brand equipment. So that could be selling to a farmer that has a 5-year-old competitor A and a 10-year-old competitor B. We don't mind. We're going to sell a technology module onto those machines that help take that machine and give it more capability, more precision. And so it grows not only AGCO core, but this mixed fleet opportunity. And the reason we do that is we want to serve every farmer, not just those farmers that have in the past bought our equipment.
Eric, you have a long-term target here of 12% operating margins. I'm curious how this deal impacts and influences that bogey, Eric.
Well, we had that target before we announced the deal, and this really just changes our portfolio mix. It's 30% margin kind of business at a high growth. I think one of the other questions Julie asked is, what's the demand? This type of business within AGCO already has been growing. We like to say 15 to 20% is our planning volume, but the last couple of years we've been growing at over 30%. So lots of growth. And that's because even though the farmer has to pay a little bit, we give them a 1 to 2 year payback. That's been always our target. Try to pay it off in 1 year for the farmer, sometimes in 2 in terms of the value they get. And so that's generating the underlying demand. That leads then to the margin question. 12% was prior to this deal. All of the analyst reports are coming out and they see us going much higher. We haven't committed to a target yet in terms of margins. We have committed to a target in terms of size. We had aimed for our precision ag business to grow to $1 billion by 2025. We now see our way to growing that to $2 billion by probably 2028 or even earlier. So scale is going to be a lot larger of a high margin, high growth business within our business. And I'm sure that'll lead to a raised targets in terms of margin.
And Eric, explain to me exactly the structure of the joint venture, right? So this is going to be a standalone joint venture. It won't trade separately, right? Is it that you collect 85% of the revenues and other proceeds from it, and Trimble gets 15%?
We'll actually consolidate the entire financials within AGCO. So you'll see that in our revenue and in our operating margin. And then Trimble will receive kind of a below the line equity investment transfer for their 15% participation. But the overall business, it is a standalone company, but it won't trade on its own. It will consolidate under AGCO's financials.
And Eric, finally, as we speak, we've got flooding here in New York City and the broader region. Just another reminder of some of the changes that climate change are bringing to us. Obviously, it's disruptive here in a city, but it's also very disruptive if you're trying to grow crops for a living. How much of this precision ag is aimed at trying to mitigate some of those effects and still get those crop yields with unpredictable weather patterns?
Yeah, unpredictable weather globally, whether it's too much water or not enough in terms of drought. Both of those are big issues all around the world, getting more severe, getting more prevalent. That just puts a headwind on the global ability to grow crops. And that's coming at a time when the farmer has to increase yields. We're going from 8 billion people to 10 billion people. We're eating more meat in our diet, which is a multiplier, using more biofuels. So those two are fighting each other, all putting pressure on the farmer. And the only real solution are these precision ag technologies. That's why they're growing so fast. That's why there's so much value generated for the farmer. They have to grow yields while using less inputs, and precision ag is the avenue to get that. It's really coming through automated features, which is on a stepping stones on the way to automating the entire machine, having autonomous vehicles running, which we showed in the field this summer at our Field Tech Days, and committed that by the end of this decade, in 2030, we'll have the full crop cycle automated. Planting, spraying, harvesting, all operating, optimizing itself, no operator in the cab.
Fascinating stuff. Eric Hansotia, great to catch up with you again. Thanks for being here.
So great to see you. It's an exciting time. Love to be in agriculture and a huge day, pivotal day for AGCO.
Take care, Eric. Coming up, closing bell on Wall Street, the end of the month, the end of the quarter. We've got all the latest market moves, and we'll sum up what it's been looking like. Stay tuned.
All right, the closing bell on Wall Street. Let's do a quick check of the market, sponsored here by Tasty Trade as we head into the weekend and ending what has been a tough month for the bulls, with now what looks like a government shutdown perhaps on the way. The Dow was higher on the day, but you can see we are finishing down about 0.5%. The S&P 500 down about 0.3%. The Nasdaq up about 0.1%, Julie.
Yeah, the S&P 500 finishing the month down about 5%. In just a few, we're going to go to our Jared Blickery as the numbers settle, and he's going to give us all of the big numbers on the month and quarter that was. Well, the United Auto Workers expanded their stand-up strike, this time focusing on General Motors and Ford. UAW President Shawn Fain reiterating the union's determination to achieve its key demands.
We will not be intimidated into backing down by the companies or their scabs. Our cause is just, striking for a better future to protect our communities and to defeat corporate greed is not just our right, it's our duty.
Joining us now, Willett Advisors Chairman and CEO and former head of the Obama Auto Task Force, Steve Bratner. Steve, it's great to see you again. Obviously, we just heard some fierce rhetoric there from Shawn Fain, which we have come to know him for in this time that he has been at the head of this union and really leading this strike. It seems like on some points the union has softened its demands to some extent. For example, reportedly now looking for a 30% increase instead of a 40% increase. What do you think here? Do we get some kind of agreement given what you've been seeing between the two sides?
I think eventually we'll get an agreement, simply because eventually every strike of consequence like this one does get settled. I would concede that this one looks tougher than many others for two reasons. First, because it's being played out in public, which makes it more difficult for either side, both sides, to back off of demands as the negotiations progress towards some common sense. And secondly, because the UAW, as I've said, has many, many legitimate requests, demands, whatever you want to call them, but they've also asked for some things that are just simply not possible for the companies to comply with, and we'll have to see how they walk back from that.
And Steve, when you mention that, impossible to comply with, what are you specifically referring to?
Well, for example, they want to be paid for 40 hours a week, but work 32, with 1 day a week being a personal day off. That obviously is very hard. They want to go back to the old system of defined benefit pension plans, which I certainly think is a better place for workers to be, but it's something that pretty much as a country we gave up 20, 30 years ago, and there have been very few new defined benefit pension plans created. They want to improve retiree health care benefits, which again I'm sympathetic to, but they have pretty generous ones relative to most other retired American workers, and you simply can't turn back the clock to where we were 20 or 30 years ago and maintain a viable Detroit set of companies.
Well, and on that point, Steve, how should Americans understand the auto business right now? In other words, the union says, look at these executives making a lot of money, look at the record profits that these companies are making. How tough is it for the automakers right now? Because on their side, they would say, well, you know, our margins are slim. We can't just be throwing around money willy-nilly. Where's the truth of the matter lie?
As with most of these things, somewhere in between. But so look, to take them in order, executive compensation, as I've said over and over again, is out of control across corporate America. The fact that the CEO of General Motors has gone from making 60 times the average worker in the late 1970s to 360 times the average worker today is unconscionable. But then you say to yourself, do you solve this problem by bringing the top down or the bottom up? I certainly would like to bring the bottom up, but the total dollars involved become very large relative to the dollars you save by bringing the top down. And I'm in favor of bringing the top down, but it's not going to create a pool of money that's going to meaningfully change things for the American workers. On your second point, yes, they are making record profits. They also are facing a pretty tough competitive situation. And I would again point out that if you bought a share of General Motors when the company went public, you would have received some dividends along the way, but the stock price itself has not changed at all, even though the stock market as a whole is almost 4 times higher than it was back on that day. So this is a tough business. I have been around this business. It is a tough, globally competitive, relatively low margin business in which costs do matter. And that's why these companies are fighting so hard. I'm very sympathetic to the workers. They have not gotten the kind of increases they need to keep up with inflation. But manufacturing is a very different space than driving a UPS truck or flying an American Airlines plane.
And Steve, the issue has become very politicized. I don't think that surprises anybody, but the engagement of Biden and Trump, is that helping or hurting, Steve, the ability to actually get a deal done here?
Hurting. I don't think there's any real precedent or argument for leaders or presidents to get in the middle of these kinds of negotiations. If it involves something like the railroads, where there are national economic implications, I can understand that the federal government has a role. But in this case, I think it just simply inflames the situation. I think that the president should not have gone on the picket lines, but he was egged on by Trump going to the other factory in Michigan the other night. And so I get why he did it. But none of this is helping reach a resolution, in my opinion.
You know, sort of strike aside for a moment. As you said, you've been around the auto business. Is there a way for U.S. automakers to better compete, whether that is some kind of, operational change they should be making, or it's some sort of regulatory or policy change that should be happening?
I think the auto companies are in a much better place than they were 15 years ago, obviously. They are making good profits. They have dramatically improved their management. This was an industry that did not have good management at all, especially General Motors, when we showed up 15 years ago. A lot of those problems have been fixed. But they are still in a tough competitive world. And the issue is that you have to think of labor in the auto industry as a worldwide commodity, if you will, that you can source labor from the Midwest, where these companies traditionally have done most of their manufacturing. You can source it from the South, where there are ununionized plants, both Japanese and other countries, where the workers get paid half or 2/3 of what they get paid around the Midwest area. You can source it in Mexico, where workers get paid as little as $9 a day, and by all accounts are very, very productive. And that's the problem these companies face. And it's not a pretty picture. And I don't take any joy in it. I take a lot of unhappiness about the situation. But this is the world we're living in, and we have no choice but to try to be competitive, which means holding down costs, unfortunately, including those of labor.
And Steve, final question. I'm interested just to pull back the lens here. Of course, we see big labor on the move here. It's not just the UAW. It, of course, Hollywood actors and writers, UPS workers, airline pilots. The pendulum seems to be swinging here a bit, Steve, back to labor. I'm interested to get your take on that. Why you think that is, what explains that dynamic, and what you think it means for companies across different sectors and industries in terms of their labor expenses and their profit margins going forward.
Look, I think that's broadly a good thing. I think that the power of labor has been circumscribed for 40 years, going back to Ronald Reagan and the air traffic controllers. And that has had consequences for all American workers who've not seen their share of the pie go up commensurately with the share that's gone to corporate profits. And so if you look at the economy broadly, that is definitely a development over several decades, as I said, that is not welcome. It's come back up today because we have a 3.8% unemployment rate. There's still 1.5 open jobs for every American looking for one. And so the supply and demand of labor, just to get back to sort of economics 101 stuff, has swung in favor of the workers. And they're now starting to use that ability. And I'm all in favor of it. But you have to make a distinction between service industries. You mentioned the screenwriters, for example, and a manufacturing worker. Whether the screenwriters get paid more or less, or the LA hotel workers are on strike at the moment, I believe, get paid more or less, doesn't really change the competitive situation. Those workers have to be sourced locally. If they get paid more, it comes to some degree out of corporate profits. To some degree, probably prices go up a bit, But that's all fine. That is simply redressing the imbalances that have occurred. When you get to manufacturing, which for better or worse is now a relatively small 10, 15% of our economy, that's where you get back to this global competition phenomenon that I just described, where if you pay those workers more, it's going to simply eventually mean, if you pay them much more, they should get paid more, but if you pay them a huge amount more, it's going to simply result in jobs moving. When we took over, and we got involved with the auto companies in 2009, the number of auto workers in Mexico had just about reached the number of auto workers in the US. Today, there are substantially more auto workers in Mexico than in the US. And that's not an accident, it's not a coincidence. And there's not much you can do about it except to try to find a reasonable balance between having these workers get paid a living wage, a fair wage, but also the companies being able to compete against companies elsewhere in the world that have lower labor costs.
Steve Ratner, thank you so much for your time today. It was great insight. We appreciate it.
Thank you, guys. Take care.
Now let's check in on a few of today's top trending tickers. Nike shares closing the week on a strong note on the back of its first quarter earnings report. The retail giant Nike signaled easing concerns regarding a slowdown in China and saw inventories dip 10% compared to a year ago in its first quarter. So we talked about this one, Julie. It was beaten down heading into this print. Investors were sellers. There were even some analysts on the street heading into the print. They downgraded their rating, right, because they were worried about the consumer. They were worried about the China. And now maybe in part just a sigh of relief here today.
Yeah, most definitely. But a couple of things that are fascinating to me about this. One is the ripple effect that we are seeing, not just in other shoemakers today, right? Everything from Puma to Adidas to On Holdings. We were seeing a boost there, but also many of the retailers who sell through Nike shoes, from a Foot Locker, even I think Kohl's was getting a bump today. Under Armour also got a bit of a halo effect. And the reason for that seems to be specifically what Nike said about inventories, where it saw some improvement in its inventory levels. Nike had embarked on a bit of a strategy to cut prices in order to clear out its inventory glut. And that seems to have worked. So then the thinking is, well, if it can do it, then others can, and maybe then they'll see some stability in prices and not as much cutting in the prices, perhaps. So that seems to be some of the chatter that I'm seeing around this broader ecosystem, if you will.
No, to your point, I mean, you look at the athletic gear sector today, Foot Locker, Under Armour,
I forgot Dick's.
Skechers.
That was the one I forgot.
Yeah, absolutely, all in the green.
Yeah, so big increases there. Here's a fun one that we've been watching today. Blue Apron shares. Haven't talked about that in a while. Higher after it was announced that Wonder Group would be buying the online meal kit company. Blue Apron stockholders will be entitled to receive $13 in cash per share of Class A common stock through a tender offer. So the shares up 134%. Overall, it's about a $100 million deal. Now, Wonder is an interesting company. This is Mark Lowry's food truck company that then pivoted into sort of a ghost kitchen company, right? Yep. But Blue Apron has been beat down for years. It's a very crowded field now.
Went public at $2 billion, and then competition, Amazon, Kroger.
Exactly.
Yep.
But lots of different meal kits. I mean, like every time you listen to a podcast, you can't get past it without hearing some meal kit promo and ads. And so it's a very crowded field. But I mean, like, look at the highs of where we saw this stock.
Yeah, but now Mark Lowry weighing in here, he's saying this is going to bring him one step closer to achieving his goal, Julie, of creating a super app for mealtime.
Super app for mealtime. We'll see if that works. I actually used Wonder when it was still the food truck company. So basically what it would do is they would drive the truck to your house and cook the food, like sitting outside of your house and bring it to you.
And listen,
right.
when Mark speaks, a lot of people listen. Incredible track record. He's the one, of course, sold Jet.com to Walmart for around $3 billion. So when he speaks, people tend to perk up. True. Yep. Shares of Anheuser-Busch rising today after Bank of America upgraded its recommendation for the stock from a hold to a buy, citing margins appearing to have reached inflection point as cost of goods sold pressures have started to ease. Of course, this one, Julie, we know got caught up in a culture war issue that did affect the brand and the business. But this analyst sees better times ahead, talking about margins, but also talking about how they think this is a brand that's better positioned, especially in markets like Latin America.
I mean, basically, at what point does the negative get priced into the stock? Right. And so this analyst is effectively saying it's been priced in. Yep. And so after the beating that the stock has seen this year on the heels of that Bud Light promotion that went wrong for the company on a number of different levels, Now, it's time for people to take another look, is what this analyst is saying.
Even with the pop here, though, still down nearly 10% on the year.
Yeah, exactly. Interesting two-year chart. There also a lot of volatility. Well, as we talked about, we're going to give you the wrap-up on the month and the quarter coming up in just a bit from our own Jared Blickery here at the New York Stock Exchange.
The founder of FTX, Sam Bankman-Fried, who presided over the largest crypto collapse in history, is about to go on trial next week. He has pled not guilty to charges that he embezzled billions in customer funds to prop up his ailing crypto hedge fund. Convictions on all counts carry up to 110 years in federal prison. Alexis Keenan is here with more. Alexis, this is going to be a huge trial.
Absolutely. The trial is set to begin on Tuesday in a Manhattan criminal court, and it will begin with the selection of 12 jurors who will be tasked with deciding the fate of the now 31-year-old Bankman-Fried, the former CEO, and once considered among the industry's most powerful players. Now, he has pled not guilty to 7 counts of fraud and conspiracy. Prosecutors say that he routinely stole customers' funds that were held on deposit on FTX's various exchanges to gain interest-free capital that they say he then used to on both private expenditures and also to pay the debts of his related hedge fund, Alameda Research. Now, this all comes to a head less than a year after a run on FTX's deposits in November exposed that the exchanges were insolvent. SBF, he's known as SBF, Sam Bankman-Fried, he then relinquished control of approximately 130 FTX related companies that then filed for bankruptcy. He was arrested that following month in December, and he was out of custody all the way up until August when he was jailed on questions of witness tampering. Now, at its peak, FTX, both the international exchange that was based in the Bahamas as well as an exchange in the US, together they claimed at their peak a total valuation of approximately $40 billion. Now, so far, the company under its new leadership has recovered approximately $7 billion, just a little bit more than that. Now, convictions, as you mentioned, on all counts, should Bankman-Fried be convicted on each and every one of those 7 charges, they carry up to 110 years in federal prison. Guys, there's no cameras in the courtroom this time, but we will be in court. We'll bring you the latest on Tuesday. And it looks like perhaps the trial will then begin with opening statements as soon as Wednesday.
Well, and if history's any indication, maybe SBF himself will be talking to some reporters and telling them about what's happening in the courtroom.
Who knows,
We
Julie.
shall see. We shall see. Alexis, thanks so much. Going to be very interesting to monitor that trial. Well, while Sam Bankman-Fried's upcoming trial on fraud charges can show the dark side of crypto and what its critics say is a susceptibility to fraud, on the flip side, there's also growing acceptance of cryptocurrency in mainstream finance. We've got, for example, Van Eck launching its Ethereum futures ETF. We still have the likes of BlackRock pushing for approval of the Bitcoin ETF. The flows and ebbs of the crypto craze are highlighted in a new book called Number Go Up. And joining us now is Bloomberg reporter and author of Number Go Up, Zeke Fox. Zeke, it's good to see you. I guess about halfway through the book. It is a fun read, to be sure, because there are a lot of colorful characters in crypto, as we know. But I kept coming back to sort of the question that you ask at the beginning of the book, which it kind of is the whole thing on the up and up, for lack of a better way to put it. Kind of where are you now after having written the book and looking at what's happening in the industry at the moment?
Well, great to see you too, Julie. Thank you so much for having me on. I spent 2 years traveling the world, meeting all the top players in crypto, trying to answer this question of, like, what are all these random coins? What are they really good for? And why are their prices going up and up? And what I found when I pulled back the curtain, whether that was in El Salvador, the first country to adopt Bitcoin, or in the Philippines where crypto really took off, what I found was that it didn't seem to be good for much except for gambling. And now with this FTX trial, the perception was that FTX was one of the most trustworthy places to go buy and sell your crypto. Now it's been revealed to be a giant fraud. So for me, I feel like what's happened in the last 2 years has really discredited crypto as a whole. It's hard to imagine that people are going to get really excited to buy back in, the next time some curly-haired boy genius comes along.
Your backdrop is giving me life right now, Zeke Fox. I love your sort of conspiracy theory connections here. I think I see Tiffany Fong over your shoulder here, who was somebody who had spoken up about maybe getting ripped off, probably in her words, by one of the crypto exchanges. What's fascinating to me is that there are still diehards. There are still believers in the cryptoverse, right? And I think when you talk to many of these people, even when the prices were going up and up and up, there was this sense that maybe something wasn't always right. But sort of give me some examples of the concrete things that you found that showed, besides the obvious one of SBF, that showed that something indeed was not right here. It wasn't just a feeling.
Yeah, okay, this is kind of a silly story, but one thing that I found really telling is that for the book, a lot of people told me as I looked into this that there was no way I could understand crypto unless I got some. And that I was just kind of an outsider who didn't know what I was talking about. So I decided to get some. I decided to buy a Bored Ape, one of those NFTs, if you remember those. These were like the pictures of monkeys that went for $500,000. And that was an awkward conversation with my wife. I was able to get a cheaper one. It was more like $20,000. But the process of sending my money into the crypto world, sending my real US dollars into MetaMask to purchase this ape was so convoluted, so hard to do, so scary. What I found out was like, essentially, I had to send my money to like this random, 32-digit string of numbers and characters. And if I made any typo, it would be gone. And there was like, everyone was warning me it was going to get stolen. And then I found out my money lived in like a tiny little icon next to the URL bar in my browser. And I thought to myself, wait, this is really the thing that everyone's been hyping to be as the future of finance? No one's going to do this. What's going to make a normal person try this out? Because most people, if they've done anything with crypto at all, it's just to go on Coinbase or something, or Robinhood or whatever, and buy a couple coins. But that's not really interacting with the crypto world. That's just the user experience is similar to the stock market. So once I actually tried like crypto stuff, I realized this is a terrible product, and I can't imagine that this is going to take off anytime soon.
And Zeke, I do want to ask you about Sam Bankman-Fried as well. The trial kicking off, and you met him, you interviewed him, you reported on him, hailed as a visionary, now in a jail cell. Were you surprised by that implosion, Zeke, or as you interviewed him and reported on him, did you see red flags?
So I was totally surprised. In hindsight, there were a lot of red flags that I missed. He had this exchange, FTX, and we all knew he had this hedge fund, Alameda Research, that was one of the biggest traders on FTX. That's like a conflict of interest that would never be allowed in the world of traditional finance. I mean, if you think about like an online poker site, if all the top executives also entered the tournaments, wouldn't they be tempted to cheat and like look at people's cards? So this was a conflict of interest that was out there in the open. And it turned out that, yes, like Alameda did have special privileges at FTX. And that Alameda dipped into the customer funds, borrowed $8 billion of them, and vaporized them pretty much. And that's why, Sam's facing fraud charges now. It's something that should have paid more attention to at the time.
Zeke, I mentioned at the top that we still have sort of TradFi firms, if you will, like a VanEck, like a BlackRock, that are now trying to introduce still these ETFs, the Ethereum ones that looks like have gotten the go-ahead. How should people, investors, think about those? It seems like it's still getting sort of the stamp of approval from traditional finance.
Yeah, and when I started looking into crypto a couple of years ago, the story was kind of similar. And I had this sort of vague idea that mainstream finance was about to accept crypto, that crypto was going mainstream. But then I went to my first crypto conference thinking I was going to see a bunch of bankers in suits and hear about sort of reasonable ideas about how blockchain might improve financial markets. Instead, what I saw was like a circus of crazy people, practically cult-like, telling me that Bitcoin was just going to go up and up and up forever, and that crypto would solve all the world's problems, from poverty to hunger to inflation. And what I realized is that as long as there are some people who want to buy and sell crypto, Wall Street is going to be happy to facilitate that, but they're not actually making big bets on crypto themselves. They're more just like, all right, you want to trade it, we still want your business. But they're not, it doesn't represent like a huge leap of faith on their part.
Right, I guess so. That maybe that actually validates one of the concerns of the crypto fans, which is that the big banks are not always on your side. But we'll leave that for another day, Zeke. Zeke Fox, author of Number Go Up. Thanks so much. Good to talk to you.
Thank you, Julie.
Take care. Well, it's been a tough month for the market, as we've been talking about. The third quarter coming to a close as well. Jared Blickery down on the floor behind us at the New York Stock Exchange. Talk to us about what we saw during this month. This market check, by the way, sponsored by TC Trade. Jared?
You bet, Julie. Great to be here. by myself for the most part on the floor. It's nice to see you guys up there. Let's go to the Wi-Fi Interactive, where I am looking at the sector action over the month that just was. You can see this bright spot of green is energy. That's up 1.7%. That is on the back of crude oil, which has been rallying for 4 months straight. To the downside, it's pretty interesting here. On the bottom, we have tech, that's XLK, followed by XLI, that's industrials, utilities, and real estate. Those are down 6 to almost 9%, and 3 of those are very interest rate sensitive. So let me just skip to the bond market, then I'll head back to stocks for a second. This is the 10-year T-note yield on a year-to-date basis, and in May, 1, 2, 3, 4, 5 months later, we have gone from 3.5% all the way to north of 4.5%, actually 4.57, and as we've been talking about, that is the highest price since 2007, so quite a big deal there. And when we have this surge in interest rates, a lot of time risk markets fall over, roll over, as they have, and it especially hits hard those tech stocks and those growth stocks, those long duration stocks, not the cyclicals as much, although they suffered as well. So here we see Apple down 9%. We just had a breakdown the other day, pretty significant technical event for that. Amazon just went through a really big losing streak. That's down 6%. NVIDIA, the poster child of AI, is down almost 12%, and here it is on a year-to-date basis. But you can see it's just been consolidating near its highs. That high was made on its earnings date just a few weeks ago. And then looking to some of the other spaces in the market, here's our leaders. Cannabis, the cannabis ETF MJ is one of the few green spots, followed by oil. That's PSCE is for small oil companies, and then we have crypto that's slightly in the red, not really that bad, but you can see just about everything has fallen off, and those that are hit worse are kind of the fringier parts of the market that I like to say. Here's solar energy, gambling, looks like defense. Now, I'm not going to call that a fringy part of the market, but meme stocks are, disruption are, and then you have some other parts like home builders. We're seeing Korean stocks, chip makers, and let's just skip to the semiconductors. I already went over NVIDIA. You can tell Intel here is a bright spot. That was up 3%. Global Foundries up 6%. When we take a look at software, pretty similar story here. CrowdStrike, I think that's an earnings story, up 12%, Zscaler up 5%, but for the most part, we're looking at some pretty bad returns here. Now, I will say there's a bright spot, because I've been showing this chart over the last few days. This is the S&P 500's performance by month, going all the way back to 1960. This line trending down at the bottom, that is September, so we just closed the door on that, and we open up October, and this is that cyan line right there, and you can see it's pretty volatile. We've had a lot of crashes in October. Will it happen again? We don't know, but I will say that volatility, another thing I've been hammering recently, volatility tends to spike in not only September, in October, and then we kind of get a respite into the end of the year. So the worst may not be over, but for the most part, at least the worst month statistically is in the bag here, guys.
Jared Blickery with all the action and insight from the floor of the NYSE. Thank you, Jared. All your markets action ahead, live from the New York Stock Exchange. Stay tuned. You are watching Yahoo Finance. Childcare is about to fall off a cliff. That's what experts are saying, as government funding set up in the pandemic is about to dry up this weekend. The Century Foundation is warning when funds from the American Rescue Plan run out, 70,000 centers could close, impacting the lives of more than 3 million children. Ripple effects could see parents, particularly women, forced to leave work and to cut their work hours, impacting the economy as a whole. For more on this is Chloe Gibbs, assistant professor at the Department of Economics at the University of Notre Dame. So, Chloe, this sounds pretty dire. What are your expectations?
What we will see will be less of a cliff and probably more of a slow descent down the hill back to the prior levels of childcare funding. That is not to say that we won't feel the effects of these American Rescue Plan funds drying up, because this was a substantial infusion of resources into the childcare industry. So the $24 billion in stabilization funds, total of nearly $40 billion in funds that were directed towards shoring up the childcare industry during this pandemic period and the resulting recession. So I think that the Century Foundation numbers are likely a worst case scenario. But I do think that we will experience some contractions in the supply of childcare as these funds roll back. And we know, as you mentioned, that those contractions will likely have ripple effects throughout the economy.
Well, Chloe, give us what you can about this in terms of the American Rescue Plan was, as you said, sort of meant to be a bridge, right? At a time when these child care centers were not getting infusions of money because people were at home. They weren't taking their kids, for the most part, to child care centers. Now that many people are back to work, one would think that the financial fortunes of many of these centers has improved. What are some of the different economic wins, if you will, that are affecting them at this point?
So that's right. This was intended to shore up the industry during this tumultuous period. But childcare businesses, as a general rule, they run a precarious business model. They rely on being full, that is having full enrollment at all times, because they generally have pretty thin profit margins. We're talking about a lot of sole proprietorships. And so this was a very turbulent time for them. Now that we are through that time, and as you said, many people are back to work, we still see that the childcare industry, employment in the childcare industry, is below pre-pandemic levels and has not recovered in the way that employment in most other industries has. I think a key consideration here is what has happened to wages in this period of time. And so childcare businesses, which are very labor intensive, that's their primary cost. And many of them report having used the ARP funds to pay personnel. And so what we may see in this period of funds ending is that childcare businesses have to make some difficult choices about how they sort of close the gap between their costs that they face to provide high quality care and the prices that families can afford. And so one way to do that might be to increase those prices that families face. Another might be to contract in terms of the number of hires, the number of people working in the business, which would mean a reduction in slots in the child care centers. And so both of these have effects for families because families will face increased barriers to finding affordable, accessible childcare for their children. And so I think what we're likely to see is overall effects on economic growth because in the short term, we may see parents less able to engage in the labor market. So we'll see those effects on labor supply. And over the long term, we know that this has implications for families who are unable to access high quality early care and education experiences for their young children in terms of future productivity. So I think we are likely to see these kinds of ripple effects. A lot of this is being driven through the difficulty for childcare businesses to recruit and retain staff in the context of what is a tight labor market.
And Chloe, reports I've been reading, though, did indicate that even as federal funding expires, states have actually stepped in here with new or expanded programs to kind of plug in those holes. One, is that accurate? And two, how much of a buffer does that provide?
That's right. I think that there have been a number of ways in which states and childcare providers themselves have anticipated the expiration of these funds. Some of that is through their own programs, as you mentioned, at the state level. I think other ways that that programs have anticipated the expiration of funds is in sort of investing in ways that would be temporary, with bonuses or incentives for staff, or investing in other ways in their childcare programs, knowing that these funds would then cease. And it is still the case. This is part of the reason why I think we're not falling off a very steep cliff immediately. It is still the case that some providers are still spending down on these funds. The funds have been allocated, but they haven't necessarily all been exhausted. And there are also supplemental funds through the American Rescue Plan that states and providers are still using. And so I think we will see some of these buffers preventing a very steep and sharp decline in access to childcare. But I think it is good for us to be forward-looking and think that there will be some implications, some ripple effects from the expiration of these funds.
I mean, Chloe, at the same time that we're having this whole, discussion about this, couldn't you argue that we're already in a childcare crisis, certainly an affordable childcare crisis in this country, even before we would get a wave or at least some closures within the industry, right?
That's exactly right. So these problems in the childcare industry, these challenges, they predate the pandemic. They predate this upcoming impending cliff. There really are some underlying fundamental challenges in the way the market for early care and education works here in the United States. And they were exacerbated, or they were sort of made well known during the pandemic period, but they've existed for a long time. Families have struggled to access affordable, high quality care. And there has been this persistent gap between the prices that families can afford and what it actually costs to provide high quality childcare. And so some of the ARP funds have sort of served to fill that gap, I think. And what we might see then is a return to the state of the world in which we are still facing these fundamental challenges in the care market in ways that constrain families' ability to engage with the labor market, to make the kinds of choices that would be best for their children and for them. And so I think that we've been facing these challenges for a long time. We're still going to have to confront them. This constituted a huge infusion of resources into that industry, but we're still facing those underlying challenges of the high costs of providing high quality care, the thin profit margins and precarity of these businesses, and those will persist into the future.
Yeah, unfortunately so. Chloe, thanks so much for joining us. Chloe Gibbs is University of Notre Dame Department of Economics Assistant Professor. Thanks so much. Appreciate it.
Thank you.
We're going to be talking more about people getting back to work in the office and what that entails next. Well, while the tech industry has been hit by layoffs over the last year, Kaseya, a global IT and security management software company, has set out to add more workers and add them in the office. Earlier this year, the company invested $16 million in an effort to create more than 3,400 new jobs at their Miami headquarters over the next 3 years, all while bucking the remote trend and being 100% in the office. We're joined now by Fred Vokola, Kaseya CEO. Fred, this is unusual, I would say, in the tech industry specifically, to say, we're going to hire you, but you got to be here in the office. A lot of workers have said they want the flexibility. They will not work for a company that does not offer it for them, at least in the tech industry. So how do you get around that?
Yeah, it's interesting. I mean, every company does what works for them. What works for one company doesn't always work for others. What works for us is having an in-office culture. One of the things that we're very proud of, or one of the parts of our strategy, is something we call a grow your own methodology for employees. So we hire a lot of people that are younger in their careers, or younger or less experienced relative to the positions that they want to go into. So having people that are more senior around them to mentor them, having teammates around them, literally within an arm length away to ask a question or to help build that camaraderie and that culture, it's proven to be tremendously advantageous for us. I mean, we're in a tight labor market. It's gotten a little cooler over the last several months, but I think we're in a historically very tight labor market, particularly in the technology space. So we look to find people that have raw talent, and we teach them some of the skills that they need to learn. And a very important part of that strategy and that methodology is having the ability to learn, to mentor, and to be mentored by people they can reach out and touch or that are right near them. So for us, it works, and we've had a lot of success with it.
And Fred, did you get any pushback, though, from some folks who said, listen, live in Miami, I really prefer working on the beach? If you did get that pushback, how did you deal with that?
Yeah, so I'm not sure if people working on the beach would be a great fit. It's kind of difficult to actually work while you're on the beach. But there's a large number of people in the workforce that want to work from home or want remote work. And from our perspective, that just we don't find that the employees are as successful in that type of situation. So if that makes up 15, 20, or even 30% of the potential workforce, those are people that we consciously realize wouldn't be a great fit here. So we do eliminate them from the potential hiring pool. However, that leaves 50, 60, 70% remaining, and we believe we are the best option. We're one of the best options in the world, not just in Miami, for people that want to go into an office or recognize that being in an office, if it accelerates their career, if it makes them more productive and more successful, is an option for them. So it's kind of like we understand that some folks won't want to work at Kaseya because of that, and we accept that as a part of the strategy, and we embrace it, and we continue to recruit from those who accept it.
And Fred, is there something also about being in Miami specifically that maybe makes this easier for you? In other words, I think about sort of Silicon Valley culture right now. There are some companies that have said it's the rare company I've heard of that said you got to be back all the time, right? Some of them have said you got to be back some of the time, but most are still offering flexibility. But in Miami, do you feel that the culture is a little more amenable to being in the office?
Yeah, well, so if we go back to the pandemic, when we came back to the office, we didn't come back in a draconian way and said all of a sudden on X date, you must be in the office. It was a 4, 5, 6 month process where we were allowing people to retransition their lives. We were out of the office in some countries for years. We're a global company. So what the situation was, for example, in New Zealand was very different than, say, in Florida, or in Florida was very different in our office, say, in Boston. So we weren't draconian about the return. We recognized people's lives changed, and we worked with people, and in some parts of the world, it was up to 9, 12 months before we went back to what was pre-pandemic normal, which is, we have offices and people work in them. So, from the perspective of the initial return back, it was very, very gradual. Now, moving forward, in terms of how we look and we bring people into Miami particularly, I don't know if Miami has anything unique about it or not that allows us to have this kind of success with a work from the office culture, because we do it in other offices around the world. I will say in Miami, Kaseya is a fairly well-known brand. We have a pretty good reputation, and we have a lot of employees in a city that's, for a very large city, it's still a small town. You know, a lot of people equate it to the largest small town in the country. So I think the reputation precedes it, and we're able to achieve super talented individuals that are very highly motivated, and they see the benefits of being around mentors, of being given opportunities much sooner and much more often than they might otherwise get at other companies. Where the geographic proximity of Miami and the mass transit also helps. You know, there's a number of rails, there's the Bright Line that just got put in. So the accessibility to work in Miami, and we are located right here in the financial district of Miami, an area called Brickell. It's the downtown of Miami, if you will. And I think folks in the Valley and even the folks out in Boston that are on the 128 belt, the other big tech hubs, those are long commutes for a lot of people, fighting a lot of traffic. So I think that may contribute to it, but I do think that people recognize Kaseya for the opportunity it is. And I don't know if I think that transcends geography.
Fred, thanks for being here. Fred Vocola, Kaseya CEO. Have a good weekend.
Great. Thank you for having me.
We'll be right back with What You Gotta Watch next week. Keep it right here on Yahoo Finance. It is closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. A war of words between the United Auto Workers Union and Detroit's Big Three. The union expanding its strike against Ford and General Motors. UAW President Shawn Fain saying they will not be intimidated by the companies when he announced the expansion. Ford CEO Jim Farley firing back in a statement saying that it is, quote, grossly irresponsible to expand the strike, and the union is holding a deal hostage over future EV battery plants. But another company securing a labor contract. United Airlines reaching a deal with its pilots union, and the contract includes a pay raise that could top 40% over 4 years. It's the last of the big three airlines to reach a deal with its pilots amid an industry shortage. The pilots' union says the deal is worth $10 billion. And the city of New York coming to a near standstill. We can tell you this from experience. As a result of continuing rain and major flooding, roads and subways facing closures and delays throughout the day. 23 million people across New York, New Jersey, and Connecticut are under a flood watch. One of LaGuardia Airport's main terminals has been closed for most of the day, and hundreds of flights have been delayed or canceled.
And time now for what to watch next week. On Monday, SAG-AFTRA headed back to the bargaining table. The Actors Union looking to strike a deal with studios. This coming after the Writers Guild of America struck a tentative deal that brought an end to its historic strike. In the legal realm, Sam Bankman-Fried's criminal trial is scheduled to start on October 3rd. The FTX founder facing 7 charges of fraud and conspiracy. And on the economic front, the ADP National Employment Report to give a read on private sector employment in September. And lastly, markets set to start a fresh new trading month after a tough September for Wall Street. The Nasdaq and S&P 500 wrapping up their worst month in 2023.
Well, that'll do it for today, this week, this month, this quarter for Yahoo Finance. Be sure to come back Monday. We'll get a new quarter and a new month underway here, 3 p.m. Have a great weekend, everybody, and stay safe.